Should you invest when the market is high? Well, here to talk with us about that is Kent Schmidgall from Buckingham Strategic Wealth. Kent, welcome.
Thank you. Thanks for having me, Robert.
So you recently wrote an article about this very topic for Retirement Daily. We're eager to have you walk us through it.
Sure. Yeah, one observation that I've made, Robert, during my career as a wealth advisor is while it's natural and understandable that someone might get skittish, that a client might get skittish when the markets drop, I was surprised to learn over the years that some clients also seem to be even more skittish when the markets get high. And this can result in questions along the lines of, should I reduce stocks? Should I eliminate stocks? Or if we're onboarding a new client, or if an existing client has cash to invest, a common question is, should we put this in the market all at once?
So what advice do you have for those folks who are skittish and have those kinds of questions?
Yeah, I think the first thing, Robert, is to acknowledge that we hopefully most of the time are logical creatures, but we are very emotional creatures. We are not all Vulcans like Spock. And so I think it's okay to embrace and acknowledge the emotional discomfort that we might feel when investing a lump sum of cash. And so a couple of recommendations that I have, or thoughts that I have around this subject, is the way I approach it is we talk about the mathematical, logical approach to in investing a lump sum of cash. Mathematically, the evidence would support investing a lump sum all at once, because we do expect stocks to go up. There is an expected return for stocks to go up. So mathematically, we do think that the evidence leads towards investing a lump sum in cash. However, if that makes somebody feel so uncomfortable, the notion of investing a lump sum of cash and then watching the market drop, if that incapacitates them, it's entirely okay to have a discussion around what we would call dollar cost averaging, or which is just a fancy way of describing investing, spacing out investments over time. For example, investing a third up front, another third in a month, and then the final third in 2 months. That would be an example. So I think that is a form of risk management, Robert. It's acknowledging that we do carry some discomfort. We have an emotional reaction, perhaps some of us, to investing a lump sum, acknowledging it, but having a disciplined process to allow us to move forward. That's a lot better than just staying in cash for the rest of our lives because we can't take the plunge.
Right.
So that would be one recommendation that I would have around this topic.
Okay. Any other recommendations then in terms of how to approach the notion, the possibility that you're investing when the market is high?
Yeah, the other concept or recommendation is really kind of a timeless principle, and that is the principle of diversification. I distinctly remember, Robert, talking with onboarding or implementing a new portfolio several years ago, and the market was at 18,000. And I remember thinking, boy, that's really high. And you'll notice the trick that I just pulled. I referred to the Dow Jones Industrial Average as the market. When people talk about the markets, they're almost always talking about US large cap stocks. So if we diversify our holdings, then the market really is not the Dow Jones Industrial Average or the S&P 500. A properly diversified portfolio, I believe, is one of the best ways to mitigate the risk of one component of the market crashing. And if somebody is very sensitive to a huge downturn in the market, and as an aside, who among us likes market crashes? That's why we would tailor a portfolio to somebody's ability, willingness, and need to take risk.
Right.
So I think just starting with what your goals are, understanding your psychological makeup and how much risk you can stomach, and taking that into account when building a portfolio or investing new cash or determining whether or not to trim your stock holdings, I think it goes a long way to just simply start with, what are my goals? What is my risk tolerance?
Right. And it strikes me too, Kent, that oftentimes the money that's in the market is intended for a long-term goal, something beyond 5 years, and something that can withstand at least the short-term ups and downs in a market. And if that's the case, being able to invest at any given point, whether the market seems high or not, um, is something that, from an emotional perspective, says I'm in this for the long term, right? It's time in the market, not market timing.
That's exactly right, Robert. I agree with that entirely. I believe trying to time an entry point is completely futile. And in my research, Robert, while I was writing this article, I came across some information that I cite, the source in the articles, from Dimensional Fund Advisors. And I think many people, myself included, would be surprised and encouraged to find out that if you look at the average annualized compound returns for the next 1 year, 3 year, and 5 year time period, I think is what was provided, after a new market high is reached, and there are still meaningfully high returns. In other words, even if we knew exactly when in advance when the market was going to reach a new high, and there I just played that little trick again. I said the market. Even if we knew when a particular asset class, or we'll say the broad stock market, even if we knew when that high was going to be reached, it still makes sense to start investing at that high based on the evidence and based on the research.
Right. And I do like the notion of diversification. For many years, for instance, small cap stocks have underperformed large cap stocks, but in recent months, the reverse has been true, that small caps have outperformed large cap. So the ability to have a broadly diversified fund allows you to have assets spread across all those classes. And when obviously the purpose of diversification is that when one asset goes up, another one might be down, and when one is down, another one might be up, right?
Exactly right. That, to me, diversification is a form of risk management, and so is, I guess, if I could boil the article down to two things: diversification, and if you're uncomfortable taking the plunge all at once, space out the investments and embrace the psychological aspect of our being.
So we've covered a lot of ground. Anything that we haven't touched upon that you want to emphasize, or anything that you touched upon that you just like to reemphasize?
No, I think that the one thing I might leave listeners with is, or viewers, or whatever medium where people are viewing this on, what I tend to ask people that when we're having this conversation about, should I invest when the markets are high? And I get this from my colleague Larry Swedroe. It's a very rational but also a powerful question. Okay, if you invest a portion of your portfolio front, now that you've done that, would you like the market to go up or would you like it to go down? There's an inherent tension there that I think kind of underscores why the evidence would lead us to simply invest a lump sum all at once. On one hand, of course, if I invested a portion of my cash, I want the markets to go up. On the other hand, if it tanks, my next installment, I'm going to buy at cheaper prices. So again, that's the logical component of the conversation. If I stopped there and didn't embrace my client's psychological component, then I think that could be off-putting. But it is still a very good logical question to ask, and it does kind of frame the question in a very simple format, in my opinion.
Yeah. Well, I'm certain that a good many people will benefit from reading the article and watching this video. So it's greatly appreciated that you spent time with us today.
Yeah, I appreciate your time, Robert.